What's going on, guys? This is Squid Trades from IN Trading. Today I'm going to be showing you an example of why it pays to wait for a bounce. On July 7th, I was asked by one of our users to check out the chart DraftKings, where they asked me if it was a good idea to look into the 814 $40 calls because they thought it would be profitable. So I was able to look at the chart, and my initial response back was it probably wasn't the right time to do it because of the fact that a bounce has not formed on our chart yet. And as you can see here, so we have a little red candle where we almost touched our $30 mark on the fib. This isn't really a good price yet of something that I would consider a bounce because at a lower point at 27.53 is where we saw that buyers loved an absolute low and was able to pick up the price from that point. So as you can see, if on the 8th the person decided to buy these calls, they would have been a little happy and they would have made a profit. But we all know that new traders like to be greedy and they like to hold on to their profits and they try to let it ride. This in turn, a day later would have, we would have seen a little bit of drop in price and the volume that goes along with it started to decline. And the day after that, we saw volume at an absolute low with what is known as a spinning top, which does like to show us that a possible change in price is about to happen. The lack of volume on this as well shows me that buyers were not here, nor were the sellers, so nobody really liked the price at this point, basically showing it could go either way. And of course, the day after that, we see a nice big fat red candle of everybody selling off. And the day after that, we see one more candle with a very long wick touching the price that we were looking at of 27.53, which then was a bounce area, as we like to call it. So basically, we saw that buyers came back into the market and they were able to pick up the price from that area. Now, if I was watching this chart and I was looking for an entry point, this area, 27.53, is where I'd be looking to make my entry in. And if I was able to do that, I'd be able to ride the wave all the way back up to the price it is now, trading at about 35, 36. And I just wanted to show as well for the pricing of the options why we would wait for the bounce. So if the guy asked me, hey, should I check out these 814 calls at $40, and I said, yeah, go ahead and buy them, he would have immediately sunk in probably around $150, which was the average cost of a contract on this day. The first day he would have been super happy, 30% up on his return. As you see, as days go on, within 5 days, he is down 57% on his investment. And like most Robinhood traders, when they see this, they get caught and they have to start asking themselves, is this a contract I want to continue to hold, or did I make a bad decision, or should I let it ride out? And a lot of times what people do is they just sell off their position, they eat the loss, and they try to move to the next one. And they get into this vicious cycle of trying to buy in, sell out of a small loss, and just keep trying that until they hit. When all they have to do is wait a couple of days, wait for a confirmation, wait for a better entry point to buy the same contract to get a better result. So you can see, instead of buying at 150, had they waited for the price to drop down to that 27.53, for that same August 14th contract at $140, which is $10 less than they would have paid, they would have been able to ride that bounce up and net 140% return within 3 days of trading. Now, of course, that is the max profit they probably could have gotten, but again, a fairly solid return for holding a contract for 2 days. And one of the other reasons that we do this is that it does usually take less capital to buy a bounce because we have already waited for the price of the contract to go down. As I noted before, there is less risk carried in this because you are waiting for a timed entry point and you're not just winging it and guessing that the price is going to go up at any specific time. And the last reason, again, I'd like to note is you don't want to get caught in a bad situation where the contract that you have is down 67%, and you're going to get stuck, and you're going to be forced to make that decision of, should I buy and hold, should I average down, should I just dump the position, did I not make the right decision, and that just puts you in a bad spot and can just lead towards a domino effect of more bad decisions, and it's hard to get back on track to being profitable. So with that being said, I hope that I was able to explain, why we need to wait for bounces and why we need to wait for those perfect entry positions, because they can be very profitable, and it's a very good thing for new traders to practice. I would recommend possibly going into the platform that I use, TradingView, be able to replay charts, and be able to try to find where those price points are, and see if you can basically pick out where those prices and where those bounces are going to be. That's an exercise you can run for 30 minutes at a time, once a day, and that will really strengthen your trading game. So once again, this is Squid Trades with I Am Trading. Please drop us a like on our YouTube channel, as well as subscribe to us. You can follow us on Twitter at I Am Trading, and you can also find us in our Discord, and that link's in our bio. Hope you guys all have a good night and learn something. Have a good one. Bye.